And I'll tell you, when you get the bankers out of your life, what a peaceful, stress-free way of life it is.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing. Real estate investing can take many forms, and today it's a pleasure and an honor to have a leader in his field, Mr. Jayson Lowe. How are you today?
I'm doing terrific, Axel. Thank you. How are you?
I'm good. I'm excited to have you on. I've been this episode has been scheduled for quite a while. You're a very busy man, and it's an honor to have you on today. So before we jump into it, I just want to remind everyone who's listening, thank you for your feedback. If you have any questions, comments, please send me some feedback because I'm planning my next episode. If there's topics or people you'd like to hear about, let me know, and I'll make sure to get them for you so we could keep building the value to give you the confidence to start investing in real estate. Now, Jayson, I will start the exact same way, even though your case is a bit different. But how in the world did you get started in real estate investing?
That's a really good question. I'll share with you that my journey with real estate investing got started in 1999.
Okay.
And now back then you could purchase. So my niche was in condominium townhomes. That was sort of the area that I just chose to be my niche in real estate investing. And my first property that I purchased was with a $4,000 down payment.
Oof.
And I thought, I am standing on top of the world. I've got this condominium townhome, part of a rental pool. So I purchased another one, and then another one, and another one, and grew to 13 doors. And I was doing what I was learning. I was part of the Real Estate Investment Network with Don Campbell at the time, who's one of the most amazing human beings that I've ever had the pleasure of getting to know. And so that's where I began my journey. And it was really more so about buying the real estate, holding it long range, generating, free positive cash flow. But what I found in my experience was I started to run into that difficulty, that ceiling of capital and having financing readily available without wanting to get into joint venture relationships or anything like that. I wanted to really just continue building it the way I was. And that all changed when I was introduced to the process of becoming your own banker, the infinite banking concept, in July of 2008. And so I was an active real estate investor between 1999 and 2008 when I changed course after having been introduced to this incredible concept that I've been practicing now the past, I'm in my 16th year now.
Yeah, and this is what I really want to talk about, because you just described what so many real estate investors go through, which is at some point you hit the ceiling. You have capital, you run out, you've been working, you've saved some, you've borrowed some, and all this, but at some point, money for down payments has to come from somewhere. And
that's right.
None of us are printing money at home, sadly. So you have to have a system. You have to have a flow. You have to have a pool.
That's right.
So what exactly is it that you call the becoming your own banker?
Well, so this concept, the infinite banking concept, was pioneered, developed by my late mentor, R. Nelson Nash, and he authored a book titled Becoming Your Own Banker. And this particular book, it's a 92-page read, takes a little less than an afternoon to get through, but Nelson wrote the book for you. He didn't write it for me, being a chartered life underwriter as a professional. He wrote it for the general public. And the essence of the concept is to not only control how you finance the things that you need throughout your lifetime, which can certainly include investment in real estate, but to recapture that money, that interest that you're presently paying to banks and credit card companies and finance companies for all those things that you need to finance throughout your lifetime. And when I was first introduced to this concept in July of 2008, it opened my eyes to a whole new financial world that I didn't even know existed. And so that was the domino that tipped over for me in changing the financial course of my life and the trajectory of my life and where everything progressed to from there. It was I'm eternally grateful for that moment in time in my life when that domino tipped over, and it all began by reading this book. That's where it all began.
Yeah, and that's something I like in your approach. And in full disclosure to listeners, I am a client of Ascend Financial. I actually highly recommend them because we had a very good experience. So,
Oh,
anyways,
thank you.
it's said. I'm transparent. I just wanted to be out there. And the
Thank you.
first comment that I had from your team was, here's the book, read it. And
Yeah.
with my wife, we said, okay, it's actually Sorblo who told us that, who's actually
Yeah.
a fabulous team member. And he said, just read the book. So we did. And then we chatted again 2 weeks later. And this is where it all started. So can you briefly describe the concept? Because for a lot of people, financing, no, you need to go to the bank and they charge you 20% when you're late on your credit card, and you need to borrow at 6% for a mortgage right now, and
Yeah.
so on and so forth. So I was going to say, in a little bit more than a nutshell, like what is it and how does it work?
Absolutely. So I can just draw on a personal experience that I think all of your listeners can relate to. So in April of 2008, a few months before I was even introduced to the concept, my wife, Rebecca, and I, so we signed a 40-year amortization schedule for the principal residence that we had just purchased. And the mortgage worked out to about 426,000. And at that time, interest rates were also quite low. Like I think our interest rate was 2.6 plus percent. Like it was really low. And so I thought, wow, this is great. We have a great rate of interest. We've got an extended amortization schedule. You could still get 40-year amortization schedules back then. And I thought that that was our lot in life. Like, hey, this is wonderful. We can afford this. It's perfect. But then when I was introduced to becoming your own banker, what I learned was how to take control of how I finance things like a principal residence. And I'll lead you through exactly what we did. So once we understood the concept and the solution to the problem, which was we're doing all the work to earn our income, but everyone else is getting all of our money. So if your listeners can relate to that, they can relate to that being a problem. You're earning income, T4 income, dividend income, interest income, rental income. But isn't it true that all of that money is flowing through the books of someone else's bank? The answers are yes. So
Mhm.
what we did was different. We began to purchase dividend paying whole life insurance policies, which when someone hears that, they say, well, why would you do that? Like, I thought you were solving for a financing need, not a death benefit.
Yeah.
But what most people don't realize is that these insurance contracts have far more financing characteristics than death benefit characteristics. Here's the key characteristic that really resonated with me back in 2008. When you purchase one of these contracts, cash value begins to accumulate immediately. And as the policy owner, you not only co-own the life insurance company, but you also have a guaranteed loan provision. I say that again, guaranteed loan provision, meaning you can borrow from the life insurance company that you co-own in the form of an unstructured loan, meaning there's no repayment schedule. You're the policy owner, you control the repayment schedule, and the lien for the loan is on the death benefit of the insurance contract, not the asset that you're purchasing with the loan proceeds. So in this scenario, when we began that journey of purchasing these contracts, building up cash value, borrowing from the life insurance company that we co-own on demand on our terms without reducing the policy's value or triggering any taxable event, the loans are not reported to TransUnion. They're not reported to Equifax. We began to use the life insurance company's money to pay down the mortgage. Every time I went into the bank with the life insurance company's money, the bank would say, well, well, Mr. Lowe, do you realize that once you get to a certain point, like you're going to trigger a penalty for doing this, and that penalty is going to be 3 months of interest. So when we got to that point where we triggered the penalty, because we had a 10% repayment privilege of the original mortgage amount. So once we surpassed that point and I showed up with money and the teller explained this to me, I said, well, can you do me a favor? Can you walk me through, like I'm plopping down another $50,000 towards the principal balance of this mortgage. Can you tell me what the interest penalty is going to be? And she said, yeah, she worked it out. It worked out to be about $1,800. Like it was nothing earth shattering.
No.
And I said, can you tell me how many years that's going to shave off of the amortization schedule?
Exactly.
And then when she gave me the response, I said, I'm just going to go get a coffee. And when I come back, you let me know what you would do if you were in my shoes.
For $1,800,
yeah,
I think it's a pretty clear cut.
Totally. So we ended up getting rid of the bank 33 years ahead of schedule.
Mm-hmm.
It took us 7 years. However, when the bank was out of the equation, now we had a policy loan balance. The $1,860 some odd a month that we were sending to the conventional bank every month as a mortgage payment is now flowing back into our family's money pool. Here's the distinction. When any of your listeners are making a mortgage payment right now, they don't see the money again. They can't earn any interest on it again. They can't use it again, not only for this generation, but for every generation that comes after them. Your debt servicing payments is someone else's passive income. I want to say that again. Your debt servicing payments, not just for the mortgage, for your cars, for your business equipment, whatever it may be, is someone else's passive income. So I said, I want to change from being in a position where money was flowing through our hands and be in a position where money's flowing into our hands. And I called Nelson. So for those of you who are viewing this, the late R. Nelson Nash, he's right here next to me each day. I miss him. I think about him. Sadly, we lost him in March of 2019. But Nelson was the first person I called when we got rid of the bank. And I said, Nelson, we did it. We got rid of the bank. And Nelson said, whoa, hold on a second. He said, remind me again, how long of a time frame did you sign on to pay someone else's bank that payment every month? I said, 40 years. He said, well, Jason, you have to finish the original loan schedule. What you're changing is the process of who's getting the money. He said, if you don't do that, your expenses are going to rise to gobble up that free cash flow. Because remember, policy loans are unstructured. When you borrow money from the life insurance company, nobody's asking you, what's your social insurance number so we can run a credit check? Nobody's having you fill out lengthy, nosy credit applications. Nobody's asking you what you need the money for. The reason is that the life insurance company itself is guaranteeing the collateral for the loan, which is your cash value. So that's why there's no repayment schedule. So now you're in a position of total and absolute control. That can be dangerous. That can
Well, you have to have discipline.
Thank you. So that can be a bad thing, right? That's why Nelson utilized that celebration as a coaching moment to say, you've got to be an honest banker and you've got to repay that policy loan because you get to reuse everything that you repay plus more. The reason is that my total cash value never stopped growing the entire time. So if I have 100,000 in cash value in the policy, which is not money, cash value is not money, and I borrow 100,000 from the life insurance company, which is real money, my total 100,000 of cash value continues rising every single day uninterrupted. And it's contractually guaranteed to match the total death benefit of the policy by age 100. And the death benefit is going up, ever increasing. So I'm aging closer to 100. My death benefit keeps rising, but my premiums for my policies cannot go up. My total cash value has to accelerate because it has to catch up to an ever increasing death benefit. And now I've got ready access capital on demand, on my terms, without reducing the asset's value and without triggering a taxable event. So logically, if I pay zero tax on the buildup of cash value, zero tax on the death benefit, zero tax on my financial transactions, how much of my capital do I not want residing there?
Most of it.
Like, and the fundamental truth is that your money must reside somewhere.
No.
And I'll share this with you. Do you realize that the largest purchasers of dividend-paying whole life insurance contracts are the banks? And so if we mirror what the banks do you think we'll do okay?
Somewhat.
Isn't that good?
It's amazing. It's an amazing system. And again, every time I hear about it, and that's why we started, is that why don't more people do this? And you know, that's a whole other question, because we've been lied to since birth, basically, about how money works.
Yeah.
But and you know, I'd love to hear your take on that. Actually, why don't more people do this?
That's an excellent question. It's one of the best questions I get asked. People who understand this do this. And when I say people, I'm talking, there are hundreds of thousands of policyholders across Canada, some of whom have no idea that their whole life insurance contracts possess these financing characteristics. So believe it or not, policy loans are nothing new. These life insurance companies have been in operation in our country since as early as 1847. So the notion of accessing a policy loan is not something that's new. What the industry has done a horrible job at is placing all the emphasis on the death benefit characteristics. So whenever somebody hears the term life insurance, whole life insurance, universal life insurance, they think, hey, you've got to die to win. Nobody, until Nelson, God rest his soul, took the time to really help educate people. And here's the deal. His book, titled Becoming Your Own Banker, has sold more than 550,000 copies. There's a reason. The process works. Now, if you look at this from a different vantage point, if you're in the commercial banking system and you need people to leave money on the books of your bank so that you can create loans, you can keep money in constant motion, you can charge interest, and you can enrich your stockholders, do you want the general public knowing that you're putting a boatload of capital into these dividend-paying whole life insurance contracts and it's one of the most stable assets on your balance sheet? Do you want your depositors knowing about that?
No.
No. So I ask people in live events all the time. I say, raise your hand if you have a computer, whether it's a laptop or a computer. Everybody's hand goes up. And I say, keep your hand raised if you know somebody who knows how to use that computer better than you do. And everybody's hand still stays up. I share with them, we're describing to you a process of how to utilize money better than you know how to utilize it now. The money's always been there. We're just going to show you how to utilize it better. And that clicks, right? For people to go, okay, I can see that. Like, these dividend-paying whole life insurance contracts have been in existence longer than you and I have been alive. And they're not going anywhere. Life insurance companies are the most financially solvent institutions on planet Earth. And so if you recognize that your money must reside somewhere, and you also recognize that someone must perform the function of banking as it relates to your needs, there are no exceptions, and that someone can be you, well, the solution, the infinite banking concept, isn't going to mean anything to you unless you understand the problem. And that's what Nelson does such a brilliant job at explaining in his book, is helping you gain clarity on the problem so that the solution to that problem actually matters to you.
Matter to you, it becomes so evident.
Oh my God.
Yeah, like, why wouldn't everybody do this?
Right.
And so before we go on, because I always want to take this as to what does it mean for a real estate investor who's listening to us, who has a couple of doors, who's, you know, investing in real estate part-time, who's got a steady job, and so on. But before we do this, I just want to make sure I summarize in very simple terms for people who are listening. So basically, what you're explaining here is that people, so we open a dividend-paying life insurance policy that has the death benefit.
Right.
So let's say I will pay, those are all fictive numbers, it's just for sake of conversation.
Yeah.
So I will go, and in order to get $1 million death benefit at death, age 100, I will pay $10,000 a year, every year, basically for the rest of my life, to capitalize a pool of cash, basically. Right. And so that $10,000 a year buys me the right to have, for my family to receive $1 million when I die. So
it would be ever increasing. So the death benefit would continue rising, but yes, you're on the right track.
Okay, so then right now it would be $1 million, but you're saying in 10 years it would be 1.3 million?
Absolutely. It would be it would be much higher.
Yeah. Okay. So then we build a pool of cash. Let's say it's essentially a big deposit box.
Yeah.
That we've contributed, because like any insurance, we pay the premium regardless of whether we make a claim or not. Yeah. And then so after 10 years of paying 10,000, I've contributed $100,000 to this pool of cash.
That's right.
And then at any moment, I can go and borrow this 100,000.
Well, you borrow against it.
I can borrow against it. Exactly.
Yeah. Like real estate investors get that, because when they grow their portfolio, what are they doing? They're refinancing, right? So they're borrowing against existing equity in a property, which equity is earning you a whopping 0%.
Yeah.
And they're taking real cash, right? Equity is not money. The equity in your home is not money.
It's value that's not liquid.
Precisely. It's value, but it's not cash.
No.
So when you want to borrow against it to grow your real estate portfolio, you have to borrow on someone else's terms. So the distinction for the real estate investor is, now I'm in a position of total and absolute control, because when I borrow from the life insurance company, I co-own that lender. I call the shots.
Yeah.
Big difference. Ask a real estate investor how well they sleep at night when they know that they have ready access capital on demand on their terms.
Mm-hmm.
They sleep really well. Ask a real estate investor who has no death benefit coverage, no estate plan, and has no plan in place to deal with unexpected vacancy or unexpected damage, whether nature or a tenant caused it. Ask a real estate investor how well they sleep at night when they know the following day they have to go and literally convince someone else's bank to lend them capital, and they have to abide by someone else's rules. One person sleeps really well. The other person has just a tiny bit of anxiety.
Mm-hmm. Well, a little bit more of anxiety, and it does not allow them to recapture, as you had said at the beginning, recapture the interest.
That's right.
That we pay on absolutely everything we buy that we finance.
That's right.
So, depending on the use of the credit card, on how you borrow, how you buy your car, how you buy real estate, all of this, why would you pay that interest to somebody else instead of to yourself?
Well, and I agree with you completely. And in addition to what you just said, every consumer realizes that when you borrow money, that capital has a cost. And so you recognize that your repayment is going to be comprised of principal and interest. That's something that you know based on your experience in borrowing money. But when you now become the banker and the bank owner, in addition to being the depositor and the borrower, then you put yourself in a position where you are now in total control, and the money is flowing into, not through your hands. There's a big difference. And in our family, this has since grown to where in our own family, we have 77 policies.
How many kids do you have, Jason?
Well, I have 4 kids, but my premiums that I pay each year are $1,056,000.
Whoa.
We didn't start there.
No.
So Rebecca and I, when we got our first policies back in 2008, our total premium was just north of 16,000 a year. The only reason that we've been able to grow our family's money pool to where it is today is because we became the banker as it relates to our needs. What do I mean by that? I mean that everyone in our family literally does their banking business within the family's money pool. We have $84,000 a month in loan repayments from family that flow back into the family's money pool every month. Now, if we took out a calculator and we did some pretty simple math, that's a lot of capital over the course of a year that was previously leaving the family forever.
Yeah.
Gone.
Yeah.
Enriching someone else's stockholders.
Yeah.
And for us, knowing what we know, we decided that we were going to become the banker as it relates to our needs. And because someone has to perform the function.
Mm-hmm.
And in addition to that, we have several thousand clients across Canada, and now clients in the United States. We operate in the United States now. And so as Ascendant Financial in Canada and Life Eva in the United States, who are implementing this process in their everyday lives. And a good portion of those clients are very active in the real estate space, some of whom have evolved from not only investing, but lending. Yeah.
Oh, bother.
And so going back to my personal journey from 2009 through 2011, early 2012, I divested of my real estate portfolio and shifted my focus and my attention to lending.
Mm-hmm.
And do you want to know how to become a really good private lender?
So I was going to just say, can you explain to us, like, how did you do it? Give us some advice, because now you've amassed over 15 years worth of experience.
Yeah.
How did you make the shift? Because you said at the time your portfolio was 14, 15 units. Okay, you sell that, you end up with a certain amount of money, and then where did you go from there?
That's a really good question. So I began the process of private lending, and that began with the occasional, we would help someone, remodel a home, purchase some new appliances, maybe a car, things like that. And the question I ask people now after, achieving this experience, I say, do you want to know how to become a really good, because people ask me, what do you do with lending? Like, when do you get to that point? Well, I would say take care of your own, become your own banker as it relates to your own needs first. So if you have any debt or any specific objectives that require capital, take care of that for your own first. And then if private lending intrigues you, the way to become a good private lender is to be a bad one.
What?
Yeah, I made a lot of mistakes.
Okay, you learn by experience.
Exactly. And so, I made a lot of mistakes, and meaning that, I lent capital in situations where in hindsight, I wouldn't do that now based on the strength of our underwriting and how we do things differently today.
Mm-hmm.
But this is such an incredible shift for people financially, especially in the real estate space, when they say, wow, like I can really, truly continue to focus on my journey of growing my portfolio, multifamily, single home dwellings, whatever your niche is. But I can also begin the process of private lending if that's something that intrigues me. And that leaves you in a position of total control, because again, think about, I'll reference a recent private lending transaction. So we lent capital to a real estate investor who required capital for a period of 6 months.
Mm-hmm.
And this was a $50,000 loan. And that loan interest rate was 15%. And those payments come in every month.
Yeah.
And what we did was initiate a policy loan from the life insurance company. So now we're using the life insurance company's capital, not Jason's capital. My capital is still inside the money pool, growing uninterrupted. So nothing's leaving my money pool. Remember, what's happening to cash value every day?
It goes up.
It has to rise. And then at the end of that 6 months term, not only had I received interest payments the whole way through, I get all my capital back. I put it right back in as a loan repayment, and I get to repeat that cycle. But now I have more accessible capital because my total cash value never stopped increasing the entire 6 months.
Mhm.
Isn't that good?
It's amazing. It's amazing.
And I'm
Yeah.
in a position of total control, meaning
Yeah.
if the investor called me and said, I need another 3 months before I can pay you back, am
Okay.
I losing a wink of sleep?
No.
The
No, it's
insurance
actually to your
company's not
benefit.
calling me,
Yeah.
right? The insurance company's not calling me and asking, hey, where's that $50,000? They
Mhm.
don't care
No.
because the lien is on the death benefit, not the real estate that that joint venture partner went out and invested in.
Mhm.
So
Now,
that's
sorry,
pretty darn good.
a question about that for those who are listening. When you say you set the terms for the repayment, so okay, I have a policy and I would choose to go borrow $50,000 against it. I
Yeah,
need to pay back that 50,000.
that's right.
How do I determine the interest rate that I'm going to pay myself? Because it needs to make sense, right? It needs to be aligned with the market right now. It needs to be aligned
Oh,
with
yeah,
no. How would that
for
be
sure.
determined?
Yeah, it's no, you're absolutely right. Like you have to, when you become the banker, then you have to become the banker. So you have to create your own loan repayment schedule that you intend to honor, and you also have to have some risk mitigation in there. So, dependent upon the strength of the borrower, that'll determine the interest rate, right? And if there's a higher degree of risk, there's a higher rate of interest. It's ridiculously simple.
Yeah.
I lend out capital at 10% when the occasion merits that. And I've done significant business with that borrower. There's credibility, track record, all of that. So you have to learn how to do it. And that's why having a good coach, whether it's at Ascendant Financial here in Canada or Life Eva in the United States, all of our coaches are authorized infinite banking practitioners with the Nelson Nash Institute. I have and continue to coach the entire advisor team. I have every confidence in anyone on my team. If you work with any advisor on my team, there's no one advisor that's above the team. Everyone is proficient, capable, because we have a system, we have a process, and we coach and mentor and lead our clients through that. And to be a good banker, you have to have your own set of criteria that would be characterized as responsible. You know, you've got to be a responsible banker, and meaning you wouldn't request a policy loan without already having planned for a repayment schedule. That would be irresponsible.
Yeah.
You wouldn't simply lend capital because you can without validating the strength of the borrower, including you. So that would be irresponsible.
Mhm.
And that's why having a good coach where you can, run these ideas past and have a good sounding board, and having someone who's experienced, who's been down that path, is so valuable.
Mhm.
And that's part of how we serve our clients. And as evidenced by, I think we're up to precisely 1,289 five-star Google reviews with
Wow.
people sharing their real experiences. On our podcast, our own podcast, Wealth Without Bay Street, we have a whole client series where clients are interviewed and sharing their real world experiences. And so this is all that we do, and we're very good at what we do. And I've never had a client call me once in entering my 16th year. Not one client has ever called me to say, I'm really frustrated that my cash values keep going up every day. It's really bothering me. Like, I'm really irritated by that.
I dare you.
Like, it's like, wow, okay, well, I suppose there are some things to get frustrated by. And, but all I can tell you is that it all began with reading Nelson's book.
Yeah.
And I had the pleasure of attending a conference in the United States back in 2008. And when I came back from that conference, I had every intention of making sure that every single Canadian at some point in his or her lifetime is going to hear about this concept. Make no mistake about it. And then
And you've done a really good job at it.
Well, credit to my teammates.
Yeah,
My teammates deserve all the praise, and they free me up to do this and to operate in my unique ability because I love to communicate and share this message. And when you have a receptive audience, it just makes it so fulfilling. And a receptive audience includes people who have never heard about this before, where it's like, wow, okay, something
there's
something
something there.
makes sense here, and
Mhm.
I would encourage you to investigate it. And the best place to start is reading Becoming Your Own Banker. That's the best place to start. And then the
That's great
next
stuff.
step, get connected with the right person on my team.
Yeah,
You'll be glad you did.
absolutely. Well, that's what I did, and just hearing you talk about it again, I'm like, oh, I have so many questions, and
All right.
I do
Yeah.
have some questions. Maybe we're just gonna take them offline,
Yeah.
because I
Get
don't want to.
together with your coach.
Yeah, yeah.
And I can promise you, your coach is going to tell you exactly this.
Mhm.
Questions get you to clarity. Keep asking. Don't
Yeah.
ever lose that. Like whenever questions come up, make sure you're asking because that'll get you closer to clarity.
And the interesting thing about it too is that depending on what we're doing through our life, we have different money needs.
Hmm.
And I mean, in our situation right now, we've been working on some deals. We're refinancing some. We might be selling some. We might be all of this, and all of a sudden, it's like, well, what is the best use for that capital afterwards? Because it used
Yeah.
to be kind of as you described, like, oh, I just want to buy doors and buy doors. And as we grow older, at least I just now I'm just like, it's not a question of doors. It's a question of living a comfortable, simple life,
Yeah.
whether it's through real estate, whether it's through other investment vehicles. That's where the real peace and freedom actually lies. So, as much as this
Thousand
is a
percent.
real estate podcast, today it's also just about your long term financial needs and ability to set up a system that allow you to have the dream life that you desire.
1000%.
Mm.
And I'll tell you, when you get the bankers out of your life, what a peaceful, stress-free way of life it is. And
On-
we're blessed now. I mean, we don't rely upon a conventional bank for anything other than the convenience of debit.
yeah, I was going to say debit and credit card, maybe.
Yeah,
Ah.
I love
Hey,
them
another
points
question. So, a quick other question. So, I have two young kids, 5 and 7 years old. Should I open policies for them now?
all day long.
Yeah, that's what I'm
And
thinking.
the reason, among many, is that you're doing something for them that they can't do for themselves today.
Mhm.
You're giving them a gift that doesn't require any batteries. It's not going to end up in a toy graveyard someday.
Yeah.
It's never going to be too small. Your kids, like you, like me, they're going to need the use of money for a wide variety of things throughout their lifetime. So if you put them in a position at this early of an age where they're beginning to accumulate cash value, if you do this properly, and you've got a great coach, so I have no doubt that you will do this properly, you can put your kids in a position where they will never rely upon a conventional bank. And then the money's flowing into the family's hands, not through. Big difference. I ask
Huge.
people all the time, hey, how much do you make? Oh, I make 100,000 a year. No, you don't. You handle
Yeah.
100,000 a year. You don't make 100,000 a year.
You might touch 55.
I want you to think about this. Think about all the money that you've spent up to this point in your lifetime. Doesn't matter what you spent it on. Just think about all the money that you've spent up to this point in your lifetime. Do you have the number approximate just in your mind? Don't say it, but if it's in your mind, let me know.
Yeah.
Ballpark. Could you write me a check?
I don't want to share on the air.
Could you write me a check for that amount of money right now?
No. And that's the one thing. When I had heard you talk a little while ago, you said that very question. Imagine you could still recapture now all the money that you've spent in your life. And I was like, ooh, that's a very different way to look at the reality. Because
Think
then
about
by
it.
age 40, which I'm now, I'm like, oh, imagine if I would recapture.
Yeah.
So that's food for thought.
All that money has flowed through your hands.
Mhm.
So think about the rest of your lifetime. You're going to be around a long time. Otherwise, you wouldn't have been approved for life insurance coverage, permanent coverage. The insurance company thinks you're going to live a long time.
I will.
So you're going to need to use some money. It's a simple question that seems logical, but people aren't asking themselves because nobody's having the conversation. How much of those future dollars do you want flowing into versus through your hands? It's a simple question.
Yeah.
You can work toward having all of it flow into your hands, but that's going to take you many years to do. That's what people need to realize. This is not ordering something from Amazon. This is going to take you many years to accomplish. But you know what? The time's going to go by anyway. And you said to me before hitting the record button, you said, I wish I would have known about this 10 years ago.
Yeah.
My response to you live in the show, you can't say that 10 years from now. Because you're actively pursuing this now, and you're on your way. You're taking a progressive step forward. The point is, the longer you wait, the more you penalize yourself. Someone else is getting all your money. How soon do you want to plug that leak?
Yeah, I know, for sure.
You know, I use that analogy all the time.
For the kids, you know, like we've stopped contributing to it, and we're due to open policies for the kids as well. That's our next step.
Yep. Your kids are going to look back on that many, many years from now, and they're going to say, thank you for doing something for me that I couldn't do for myself at that time.
Jason, I could keep going for way too long on this topic.
Me too.
It's so important. No, and you explain it in very simple terms. Anyone listening to this understands and would say, why would I not do this? So here's the real kicker. I've had a great experience with Ascend Financial. I highly recommend them. You can go to the website. It's Ascend Financial. And you know what? Get in touch with me, and I'll be more than happy to refer you my coach or someone around, and take it from there.
Yeah, and to give the folks both domains again, it's ascendantfinancial.ca. That's ascendantfinancial.ca. And if you're tuning in from the United States, if you have any American listeners, it's LifeEva, LIFEVA.com. That's lifeeva.com. So either website, we look forward to connecting with you. And when you work with someone on our team, you get our entire team. And I can't shower them with enough praise. They're capable, caring, competent, amazing teammates.
Thank you very much, Jason. Very enlightening for today.
Thanks for having me.
Great way to, I was going to say, to end the week. For those who are listening, it may be a Tuesday, but that's all right. But most importantly, as you're listening to this, you might be in your car, you might be running, you might be cooking or doing whatever. Share this episode with a friend. There's 3 people around you who need to listen to this and who will benefit from it. And years from now, they will thank you for it.
I appreciate the opportunity. Thanks for having me.
Look into becoming your own banker and read the book. Read the book by Nelson Nash. You can find it. It's really accessible, and it'll explain to you.
Buy it right from our website. We will.
There you go. It's free from the website.
No, buy it directly from our store because
we
sell it cheaper than Amazon.
Yeah.
And we will courier the book. We don't mail them. We'll courier it right to your front door.
There you go. No excuses.
Awesome.
On this great note, thank you again, Jason. It's been a real pleasure to have you on today. And for all those who listen, educate yourself, make the right decisions. You'll be happy later. Thank you.